Mid-cap stocks include roughly the next 400 companies by size, smaller but still fairly well established. They're considered riskier than large cap. Following large cap and mid cap, take the next 2,000 companies and you've got small cap stock. While they have potential for greater growth, they also have the greatest risk. Then there's international stock, ownership in companies located in developed nations outside the U.S., like BMW in Germany and Sony in Japan. They carry about the same level of risk as U.S.-based large cap stocks. The highest level of risk is found with emerging market stock. This is stock in companies located in developing nations like India, Mexico, and Russia. There are two ways to make or lose money in the stock market. You see, when you own a stock, you actually own a piece of a company, and as the value of that company increases, the stock price goes up. But if the value of the company goes down, the stock price goes down too. These fluctuations determine the amount of profit or loss. Another way to make money is when the company shares its yearly profit with you in the form of a dividend. Stock prices can go up or down dramatically for all kinds of reasons. As a result, stocks are the riskiest types of investment in your plan, but over a long time, they can also be the most rewarding. Next up, bonds. Bonds are just a loan to a company or government. They borrow by selling a bond, which is simply a promise to repay the buyer in a fixed number of years at a fixed interest rate. When you hear about the U.S. government borrowing money, have you ever wondered who they borrow from? Chances are, it's you, through the investments you make in bonds. If interest rates go down after you buy a bond, its value goes up. If interest rates go up, then your bond value will go down. How much the value goes up or down with a change in the interest rate depends on how long the bond is. The longer the bond, the more risk, as the more the value will go up or down with interest rate changes. However, in general, bonds are less risky than stocks. Cash is, well, cash. In a 401k, it's usually available as a money market or stable value fund. Unlike other assets, there's little risk that your money will lose value. But that doesn't mean there's no risk at all. If you hold too much cash, you are at risk that inflation will leave your money worth less compared to everything else. For example, in 1950, a nickel would buy you a Coke. But if you saved that nickel until today, you wouldn't have enough to buy that same Coke. Cash loses value over time. Most people with 401k